The IRMAA Trap: How Medicare's Hidden Tax Steals $50,000 from Your Social Security. The IRMAA Trap Promise and Payoff. If your income was high 2 years ago, Medicare can quietly tack on hundreds per month to Parts B and D and across a long retirement that can drain $50,000 from your Social Security. It often hits right after you stop working, when cash flow matters most. I'll expose the 2-year look-back trap and show how to legally cut or avoid IRMAA. You'll get the exact 2026 brackets, timing windows, appeal steps with SSA 44, Roth conversion sizing, RMD fixes, and the secret step that sometimes flips a penalty into a refund. Let's turn IRMAA from a surprise bill into a number you control. What IRMAA actually is without the headache. Here's the plain English version. IRMAA is the income-related monthly adjustment amount, an extra charge added to your Medicare Part B and Part D premiums if your modified adjusted gross income, your MAGI, is above certain thresholds on the tax return from 2 years ago. Your 2026 premiums are generally based on your 2024 MAGI. That lag is where the pain starts, because life moved on but the math didn't. Why does this matter? Because IRMAA hits cash flow directly. Social Security withholds Part B and any Part D IRMAA before your deposit lands. Cross a threshold and your monthly outflow jumps, no warning, no partial credit. Over a decade or two, that steady leak easily adds up to tens of thousands you thought you'd spend on life, not premiums. The thing most people miss is that IRMAA isn't a smooth curve. It's tiered with cliffs. Go $1 over a threshold and you jump to the next monthly surcharge for the whole year. That's why retirees get blindsided after a Roth conversion, a late-year capital gain, a severance, or a fund surprise distribution. The cliff, not the slope, is what hurts. Let me define MAGI the way IRMAA sees it. For IRMAA, MAGI is basically your AGI plus tax-exempt interest from municipal bonds. Wages, IRA withdrawals, Roth conversions, interest, dividends, capital gains, rental and business income flow into AGI. Then add muni interest on that separate line. Even tax-free bond income counts for IRMAA. That single add-back trips up careful planners. Now the actual numbers, because clarity kills fear. In 2026, the standard Part B premium is $202.90 per month. IRMAA tiers start when 2024 MAGI exceeds $109,000 for single filers or $218,000 for married filing jointly. Cross that first line and you add a monthly surcharge to Part B and another to Part D. The Part D add-on is separate from your plan premium and uses the same MAGI tiers. Different mechanics, same look back, same cliffs. Here's how the process works. Each fall, Social Security pulls IRS data, looks back 2 years, and assigns your Part B and Part D IRMAA tiers for the coming year. About 8% of beneficiaries pay IRMAA in a given year, but that percentage spikes among people with large pre-tax balances, small business exits, stock grants, or property sales. Your tier is recalculated annually, so you can move up or down as your income changes. The hidden pain is stacking. Both Part B and Part D can be affected. A small overshoot can mean 2 surcharges for 12 months. And because the premiums are withheld from Social Security, many people only notice when the deposit shrinks. They call, and the answer is a letter they barely remember opening months earlier. The common mistake is thinking, I'm retired now, so premiums should drop immediately. IRMAA doesn't care about this year yet. It cares about the tax year 2 years ago. Retire in June, but if your 2024 income was high, your 2026 premiums reflect that. It feels unfair, but there's a fix: appeals for life-changing events, which we'll cover, and better timing moving forward. Before we continue, you need to understand why the tier system creates outsized damage. Because IRMAA uses cliffs, small end-of-year decisions can cause large, unnecessary costs next year. One client went $900 over a threshold and paid hundreds more per month for the full year. If you remember nothing else from this section, remember this: check the cliff before any late-year income move. The reason this turns into a planning opportunity is that IRMAA is a formula. Manage inputs to manage the output. Once you know your proximity to a tier, you can choose which accounts to tap, which gains to delay, and which distributions to route differently. Treat IRMAA like a predictable bill and engineer your income to land just under the next cliff. Let me show you exactly what IRMAA touches so you can spot it fast. For Part B, your total premium equals the standard $202.90 plus any IRMAA add-on tied to your tier. For Part D, your plan premium is whatever you selected, but IRMAA adds a separate monthly surcharge based on the same MAGI tiers. Both rely on the 2-year look-back and the same definition of MAGI. Now here's where most people mess up. They ignore tax-exempt bond interest, they don't track mutual fund capital gain distributions, and they assume dividends will be stable. Then the January 1099s show up and the total is higher than expected. Once you've crossed a cliff, there's no partial credit. That's why we'll build an annual checklist and a Q3 no surprises review later. A quick win you can get today: pull your latest tax return and find AGI. Add any tax-exempt interest listed on the return. That's the MAGI IRMAA cares about for that year. Compare it to the 2026 IRMAA thresholds for your filing status: $109,000 single, $218,000 joint at the first tier. If you're close to a line, flag it. That single exercise tells you whether you're at risk of a tier jump and whether to slow income, accelerate deductions that reduce AGI, or consider strategies like qualified charitable distributions later. Okay, so you see the trap. It's based on 2-year-old income, it applies to both Part B and Part D, and the tiers are cliffs. Once you nail that, everything else clicks. Next, we'll tackle the 2-year look-back in detail, why timing mismatch burns people, which one-time events trigger spikes, and how to spot the $1 mistake before it snowballs. The 2-year look-back rule, where most people get burned. Let's make the timing crystal clear so the traps can't hide. The premiums you pay in 2026 come from your 2024 tax return. That's the 2-year look-back. Social Security doesn't guess. They pull your RS-reported MAGI, match it to the 2026 tier table, and set your Part B and Part D surcharges. Your current income doesn't matter yet. That delay is why people feel punished after retiring. Your lifestyle changed, but the data feeding Medicare didn't. Why does this burn so many people? Because the last working years often include one-time spikes that look harmless in the moment. A severance package in December, stock options exercised before you walk out, an RSU vesting schedule you forgot to pause, a bonus you didn't think to shift, or the cleanup Roth conversion you squeezed in at year-end. 2 years later, those choices show up as a year of higher premiums. It's not personal, it's the pipeline. Now here's the cliff effect in action. Say the first 2026 tier starts at $109,000 single or $218,000 joint, and your 2024 MAGI lands $1 over. You don't pay a $1 surcharge. You jump to the full next tier add-on for the entire year. That means higher Part B every month and a separate Part D add-on every month. Over 12 months, a small overshoot turns into big, predictable costs. That math is brutal, but it's also controllable. And the lag stacks. Retire in 2024, proud of a lean 2025 budget, but your 2026 premiums still reflect your 2024 MAGI. If 2023 and 2024 were high-income years, you could be staring at IRMAA at 65 and 66 without earning a paycheck. People open the letter, see the higher deduction in their Social Security deposit, and think something's wrong. Nothing's wrong. It's the look-back doing its job. Where do most folks mess up? Late year moves without a tier check. After a market rally, you convert the same dollar amount you planned back in August, except dividends ran hot and a fund declared a surprise capital gain distribution in November. Or you harmlessly rebalance in taxable in December and realize gains you didn't count. Or you ignore municipal bond interest because it's tax-free, not realizing it gets added back for IRMAA. All of that lives on the tax return Medicare will use 2 years later. Here's a quick win to anchor your decisions this year. Pull last year's return, find AGI, add tax-exempt interest. That's the IRMAA MAGI. Now grab the 2026 thresholds. First line at $109,000 single, $218,000 joint. If your MAGI would have crossed a line, that explains the tier you're in today. If you're not on Medicare yet, run that same math on your age 63 year. Your 63-year MAGI typically sets your 65-year premiums. If you remember nothing else, protect the age 63 return. So how do you avoid getting burned? You build a rhythm and respect the lag. In Q2, do a MAGI forecast that includes dividends, interest, pension income, known gains, and any planned conversions. Add a cushion for surprise distributions, 5–10% under the next tier. If your forecast is within a few thousand of the cliff, cap the conversion or move gains to January. In Q3, recheck with real numbers. If a fund announces a big payout, trim immediately. In Q4, no topping off without a fresh estimate. Let me show you exactly how timing flips outcomes. Suppose you plan a $15,000 conversion later in the year. markets rise, your dividend run rate jumps, and your actively managed fund posts a 10% capital gain distribution in November. If your original headroom was $18,000 in August, it's now $9,000. Convert the full $15,000 in December and your $6,000 over the cliff. 12 months of surcharges you could have avoided by converting in June or trimming the amount in October. The game changer nobody talks about is sequencing one-time events. If you'll sell a rental, take severance, or exercise options, don't stack those in the same calendar year as a large conversion. Use on and off years. In an on year, take the big event and keep everything else minimal. In an off year, resume conversions or realize discretionary gains up to your buffer. That simple cadence keeps you from crossing two cliffs with one decision. Common mistakes to skip right now. Assuming your mutual funds won't distribute, ignoring muni bond interest on that separate line, rebalancing in taxable in December without a MAGI check, and converting to the top of a tax bracket without looking at IRMAA tiers which don't line up perfectly with tax brackets. Also, don't forget Part D. The same MAGI tiers apply, so a small overshoot can double hit you. If you're already retired, here's your urgency note. If you're 63 this year, your decisions now set your premiums at 65. Run a conservative forecast, leave a 10% buffer under the next tier, and avoid December surprises. If you're 61 or 62, use these years for planned conversions and portfolio cleanup while you still have room. That's how you enter Medicare clean, no cliffs, no letters, no whiplash. The better method: control MAGI, control IRMAA. Now that the lag and cliffs are clear, here's the better method. Treat IRMAA like a controllable bill by engineering your MAGI. The reason this works is simple: IRMAA is formula-driven. If you manage inputs, you manage outcomes. Do it right and you land just under the next cliff. Miss it and you pay for the entire year. First, lock the definition you'll actually use. For IRMAA, MAGI is your AGI plus tax-exempt interest for municipal bonds. AGI includes wages, IRA withdrawals, Roth conversions, interest, dividends, capital gains, rental and business income, and the taxable portion of Social Security benefits. Then you add muni bond interest sitting on its own line. The thing most people miss is that tax-free muni interest is IRMAA-free. It still gets added back. Here's your toolkit to control MAGI without gutting your lifestyle. Roth accounts are the cleanest lever. Qualified Roth IRA withdrawals don't hit MAGI, which gives you flexibility to fund spending without pushing over a tier. The shortcut is to build Roth capacity before Medicare so you can choose tax-free income later. Next, qualified charitable distributions once you're 70.5. A QCD sends money directly from your IRA to a charity, can satisfy RMDs, and the excluded amount doesn't raise AGI or MAGI. If you already give, route it this way. Capital gains planning is your third lever. You choose when to realize gains. Use tax-efficient ETFs and index funds to minimize surprise distributions. Harvest losses when markets dip to offset gains. Bunch big sales into on years when you have headroom below a cliff. If you need steady income, consider treasuries and taxable instead of muni funds near a cliff. Treasury interest sits in AGI, but avoids the extra IRMAA add back from tax-exempt interest. Now shift from spikes to steady. Most people do a giant conversion or a late property sale and blow through a tier. A better path is smoothing moves across years to consistently land 5–10% under the next threshold. If you remember nothing else, remember this: smooth beats spiky. Even income makes for predictable premiums. Tie in Social Security timing. Delaying benefits early in retirement can widen your MAGI runway for planned Roth conversions because you're not stacking taxable benefits on top. I've seen couples pause benefits until 67, live off cash and taxable accounts, and fill a conversion target each year under the next cliff. At 65, no IRMA. At 73, smaller RMDs. Coordination is where the savings multiply. Let me give you a simple operating system. Step 1, set a safe cap. Take the next IRMAA tier for your filing status and set your personal ceiling 5–10% below it. That buffer is your insurance against surprise dividends or fund distributions. If the first 2026 tier starts at $109,000 single or $218,000 joint, a conservative cap might be $98,000 single or $196,000 joint if you want room for unknowns. Step 2, forecast early, adjust mid-year. In Q2, estimate dividends, interest, pensions, rental net, and any known gains. Add a provisional Roth conversion amount that keeps you under your cap. In Q3, update with real YTD numbers and cut if you're close. In Q4, no topping off without a fresh estimate. Step 3. Choose your spending source to match the plan. If you're near a cliff, fund extra spending from Roth or bank cash so you don't create new taxable income. If you must raise cash in taxable, sell lots with minimal embedded gains. Inside IRAs, rebalance freely, no current tax impact. In taxable, rebalance with cash flows and dividends rather than selling winners in December. Here's a concrete example. Your forecasted AGI is $118,000 joint, and you've got $6,000 of muni interest. Your IRMAA MAGI is $124,000. If your safe cap is $196,000, you have $72,000 of room. But you expect a mutual fund distribution in November and a potential $8,000 gain to finish a portfolio cleanup. You decide to convert $55,000 in June, wait for estimates in October, and then either top off $5,000,7,000 or stop. A November announcement of a $4,000 distribution, you skip the top off and stay under your cap. Now here's where most people mess up. They size conversions to the top of a tax bracket without checking IRMAA tiers. Tax brackets and IRMAA cliffs don't align, so you can be tax efficient and still trigger a year of surcharges. They also ignore mutual fund capital gain distributions that hit in November and December, which count even if reinvested. And they let muni bond interest sit on autopilot while managing to a tight cap. If muni interest keeps pushing you over, swap some exposure to treasuries in taxable. 2 quick wins you can do this week. 1. Print the 2026 IRMAA tier table for your filing status and circle the next cliff. Write your cap 5-10% under it on a sticky note. 2. Email your fund companies in October for distribution estimates. If a fund projects a large payout, swap to a tax-efficient ETF before the record date or hold that fund in an IRA instead. Common mistakes to avoid now. Cramming conversions in December with stale forecasts, rebalancing in taxable without a MAGI check, stacking a big gain in a conversion in the same year, and forgetting Part D's add-on uses the same tiers. Also, if you're using a backdoor Roth and you have other pre-tax IRA dollars, remember the Pro-Rata rule. Accidental taxable conversions can inflate MAGI. Roll pre-tax IRAs into an employer plan if available before doing a backdoor. If you remember nothing else from this method, remember this: set a cap, forecast early, adjust mid-year, and stop when you're close. That rhythm turns IRMAA from a surprise into a number you steer. Timing windows, the calendar that saves thousands. Your calendar is as important as your calculator because IRMAA is time-shifted by 2 years. Control when income lands on your tax return, and you control premiums later. So let's build a simple year-by-year playbook that keeps you under the next cliff without guesswork. Start with the prime window, retirement to age 63. These are your setup years. Your 62 and 63 returns won't hit Medicare yet, but they'll anchor your entry. The thing most people miss is waiting until Medicare to clean up taxes. By then, every dollar risks a 2-year later surcharge. Use the pre-Medicare window for steady, measured Roth conversions, portfolio cleanup from distribution-heavy mutual funds into tax-efficient ETFs, and building cash reserves so you aren't forced to create taxable income in Q4. Age 63 is the anchor. Your age 63 MAGI generally sets your age 65 premiums. Treat that return like it's written in ink. In January of your age 63 year, map every income source: pensions, annuity starts, dividends, interest, rental net, expected gains, and any lump sums. Size conversions last, not first. If a surprise arrives, an unexpected fund distribution, a special dividend, you still have 3 quarters to trim. If you remember nothing else here, protect the age 63 return with a bigger buffer, 10% under the next tier, not 5%. Once you're past 63, stagger, not surge. Spread conversions across multiple years and keep annual MAGI 5-10% below the next cliff. Use rolling on and off years. In an on year, realize planned gains or do a larger conversion up to your cap. In an off year, harvest losses, pause gains, and let cash do the work. That rhythm avoids stacking 2 cliffs in the same return. Now, let's build the quarterly cadence that actually saves money. Q1, set your safe MAGI target. Pull the 2026 tiers, first cliff at $109,000 single, $218,000 joint, and set your cap 5-10% under the next one. List your MAGI drivers: pensions, annuities, IRA withdrawals, conversions, dividends, interest including muni, rents, business payouts, and expected gains. Draft a provisional conversion amount that leaves buffer. Q2, reforecast with real YTD data. Annualize dividends and interest conservatively. Ask fund companies for mid-year distribution outlooks. If your runway shrank, pivot now, trim the conversion, stop realizing taxable gains, and swap distribution-heavy mutual funds in taxable to more tax-efficient ETFs. Shore up cash so you aren't forced into taxable sales later. Q3, lock the plan. Confirm any one-time events, property closings, option exercises, business payments, and either bring them into a year with room or push them to January. If you're within a few thousand of the cliff, cut conversions now. Turn off automatic reinvestment in taxable. If fund estimates are climbing, you can still reinvest manually in January. Q4, execute, don't improvise. Before any move, run a fresh MAGI estimate. If you're close to your cap, freeze discretionary income, no topping off conversions, no extra gains. If you're 70.5 or older and charitable, schedule qualified charitable distributions early in Q4 so they settle and count toward RMDs without raising MAGI. Complete RMDs early, check the result, and stop. Don't trade dollars for a year of surcharges. Avoiding December disasters is a single rule: no late year income moves without a tier check. RMDs, bonuses, and fund distributions bunch in Q4. If a bonus or severance is possible, assume it lands late and leave headroom. If a mutual fund announces a big payout in October, pivot, reduce the conversion, or swap before the record date. If you need to sell an asset, consider waiting a few weeks to close in January, shifting the IRMAA impact to a year you can plan around. A fast example to make this real: you're 62 now, retiring at 63, Medicare at 65. This year and next, you convert modestly and exit distribution-heavy funds and taxable. At age 63, you trim conversions, avoid large gains, and skip muni bonds so the add-back doesn't chew your buffer. At 64, with the anchor year behind you, you resume conversions to your cap. Result: at 65, no IRMAA, and your RMDs later start from a smaller base. 2 calendar automations make this hum. 1. Create 4 repeating IRMAA MAGI check events: Q1 plan, Q2 adjust, Q3 lock, Q4 execute. 2. Add an October reminder, request fund distribution estimates. Many fund families publish them, use those to preempt surprises. Common mistakes to skip now: stacking a property sale and a conversion in the same year, ignoring the age 63 anchor, letting mutual fund distributions surprise you in November, cramming conversions into December with stale math, and forgetting Part D piggybacks on the same tiers. Keep the buffer bigger in years with moving parts, especially 63 in your first RMD year. If you adopt this calendar, the math gets boring in the best way. Your premiums stay predictable, your Social Security deposit doesn't yo-yo, and IRMAA turns into a number you steer on purpose. The life-changing events appeal: how to get IRMAA reduced. Appeals are how you flip the look back in your favor. If your income fell because of a qualifying life-changing event, you don't have to wait 2 years for Medicare to catch up. You can ask Social Security to recalculate your IRMAA now using Form SSA 44. Done right, your premiums drop going forward, and sometimes they adjust back to the month the change began. Why this matters: every month at a higher tier is money you don't get back unless you act. The system isn't guessing, it's following data from 2 years ago. Appeals let you replace that old number with your current year estimate, backed by proof. If you remember nothing else here, remember this: file fast, estimate conservatively, and keep your income choices consistent with your appeal. Let's get clear on what counts. Qualifying life-changing events include work stoppage, retirement, work reduction, marriage, divorce or annulment, death of a spouse, loss of income-producing property due to circumstances beyond your control, loss or reduction of pension income, and receipt of an employer settlement payment. If one of these events substantially reduced your MAGI, you likely qualify. Here's the step-by-step. Step 1. Get Form SSA 44 from SSA's site or call your local office to schedule an interview. Step 2. Check the box for your life-changing event and enter the exact date: last day of work, divorce decree date, spouse's date of death, the day the pension changed, or the date of the property loss. Step 3. Provide your best estimate of MAGI for the current year and the next year if requested. For IRMAA, MAGI is your AGI plus tax-exempt interest. Step 4. Attach proof and submit. What proof works? For retirement or work reduction, include an employer letter stating your last day and expected income going forward, recent pay stubs, and the final W-2 when available. For marriage, divorce, or death of a spouse, include the certificate or court order. For loss of income-producing property, include insurance claims, casualty reports, or documentation of the loss. For pension changes, include the benefit change letter. The more specific, the better. Now the tricky part, estimating MAGI. Don't lowball. List wages if any, IRA withdrawals, Roth conversions, those count, pensions, annuities, dividends, interest, capital gains, rental net, business income, and tax-exempt bond interest. If you're close to a cliff, round slightly higher on your estimate. If your final tax return comes in lower, SSA can align to the actuals later without issues. If you understate and then go higher, expect them to adjust. Here's the shortcut nobody talks about. Pair your appeal with smart income sourcing for the rest of the year. After you file SSA 44, keep your MAGI under the targeted tier. Fund spending from bank cash, taxable cost basis, or Roth withdrawals to avoid creating new taxable income. If you're 70.5 or older and you give to charity, use qualified charitable distributions directly from your IRA. Those dollars satisfy RMDs without raising AGI or MAGI. Don't undercut your appeal with a late-year Roth conversion or a big capital gain. Timing is simple. File as soon as the event occurs and you have documentation. If you retired in March and receive a September IRMAA notice based on your old income, don't wait. Submit SSA 44 with the employer letter and your current year estimate. Ask for the determination to apply starting the month your income dropped. If SSA temporarily used older IRS data, request a correction when the newer return posts. Common mistakes to avoid. Forgetting to include tax-exempt interest in MAGI, estimating too low and then realizing gains later, submitting without proof, waiting months after the event, and appealing, then immediately doing a large conversion that contradicts your estimate. Keep your actions aligned with your stated income plan. Micro story: a retiree stopped work in June, then got hit with IRMAA based on a strong prior year. We filed SSA 40 for the same week, checked work stoppage, attached the employer letter, pay stubs, and a conservative MAGI estimate that excluded conversions. SSA approved the appeal, dropped Part B and Part D surcharges the next month, and adjusted back to July. Their Social Security deposit increased immediately. If your appeal is denied or only partially approved, request reconsideration. Often it's a documentation gap or an estimate that felt too optimistic. Tighten the paperwork, updated pay stubs, brokerage statements, pension letters, and resubmit. After the year closes, file your tax return promptly. If actual MAGI confirms the lower tier, SSA will align to the exact numbers for the next determination. Quick checklist you can follow today. Identify your life-changing event and the exact date. Download SSA 44 and fill it out carefully. Estimate MAGI conservatively, include tax-exempt interest. Gather proof: employer letters, pay stubs, court or vital records, pension notices, loss documentation. Submit immediately. Consider scheduling an SSA interview. Keep MAGI low the rest of the year. Use cash, basis, or Roth. Use QCDs if eligible. After year-end, file early and provide actuals if requested. Do this right and you turn the lag into leverage, dropping IRMAA now instead of waiting 2 years for the pipeline to catch up. Roth conversion strategy: avoiding the cliff while building tax-free. Roth conversions are one of the best tools for cutting future taxes and taming IRMAA, but they're also the easiest way to trip a cliff if you size them wrong. The goal isn't convert the most, it's convert the most you can while staying under your IRMAA cap. Do that, and you build tax-free assets without buying a year of surcharges. Why this matters: conversions compress taxes into years you control, shrink future RMDs at 73, and give you Roth dollars you can tap without raising MAGI. Smaller RMDs mean fewer IRMAA surprises later, especially in survivor years with tighter single-filer thresholds. Done right in the pre-Medicare window, conversions give you decades of flexibility. Let's lock the core rule. Every conversion dollar raises AGI this year and therefore raises IRMAA MAGI if you're in the look-back window for a future Medicare year. If you're 63, that conversion hits the 65-year premium calculation. So you need a sizing framework that respects both tax brackets and IRMAA tiers. They don't line up, so treat IRMAA as its own constraint. Here's the framework I use. Step 1. Set your IRMAA safe cap. Take the next 2026 tier that applies to your filing status. First cliff is $109,000 single, $218,000 joint, and set your personal ceiling 5-10% under it. If you want extra safety in your age 63 year, use a full 10% buffer. That cap is your boundary for all discretionary income. Step 2. Build a conversion budget. Forecast non-conversion income. Pensions, annuities, wages, taxable interest and dividends, rental net business income, realized capital gains, and the taxable portion of Social Security benefits. Add tax-exempt interest to arrive at IRMAA MAGI if you hold munis. Subtract that from your cap. The remainder is your maximum conversion amount before surprises. Step 3. Stage conversions through the year. Convert a meaningful chunk in Q2 after you have YTD dividend and interest data. Remeasure in Q3 with any fund distribution estimates. Only top off in Q4 if you still have clear headroom. No topping off without a fresh MAGI estimate. Now the coordination that unlocks this: funding lifestyle from cash, taxable basis, or Roth while you convert. If you cover spending from sources that don't create new taxable income, you preserve more cap for conversions. If you must sell in taxable, prioritize lots with minimal embedded gains. Inside IRAs, rebalance freely, no current tax. Social Security timing is a quiet lever. If you delay benefits, you keep current year MAGI lower, widening your conversion budget. Once you claim, up to 85% of your Social Security can become taxable depending on other income, which eats into your cap. That doesn't mean never claim early. It means run both versions and choose with eyes open. Common traps to sidestep right now. Sizing to the top of a tax bracket without checking IRMAA tiers. Converting in December using a summer forecast, dividends and distributions changed. Letting municipal bond interest chew your buffer while you convert. If you're near a cliff, swap some muni exposure to treasuries in taxable. Forgetting the pro-rata rule on backdoor Roths. If you hold pre-tax IRA money, a backdoor converts proportionally from all IRA dollars. Consider rolling pre-tax IRAs into a current 401k if available before doing a backdoor. Let me show you exactly how this looks. Joint filer conservative cap set at $196,000 for the year. Non-conversion income forecast. Pension $42,000, dividends and interest $14,000, partial taxable gains $8,000, taxable Social Security impact $26,000, and $4,000 of muni interest. Your IRMAA MAGI forecast is $94,000 so far. That leaves $102,000 of room to your cap. You convert $70,000 in June. In October, a fund announces a 7% capital gain distribution worth $3,500 to you. You trim the final top off to $25,000, landing near $192,500 MAGI. Clean, no cliff. If you're already in an IRMAA tier, decide on purpose. Either keep conversions minimal this year to drop to a lower tier next year, or if you're firmly in the same tier and can't push higher, consider making this an on year with a larger conversion that meaningfully shrinks future RMDs. Don't pay a surcharge for a token move. Age 63 warning: if you plan to start Medicare at 65, treat your 63-year conversions with extra caution. Use the 10% buffer under the next tier and lock your final sizing in Q3. If you're close, cut now. A $1 overshoot costs 12 months of surcharges later. 2 quick wins this week. Put your IRMAA cap in writing for the year and post it where you'll see it. Email your fund companies for capital gain distribution estimates in October. If a fund is projecting a big payout, switch to a tax-efficient ETF before the record date or hold that fund inside an IRA. Final guardrails. Q2 convert most, Q3 remeasure, Q4 only top off with fresh math. Fund spending from non-MAGI sources when you're near a cliff. Avoid stacking a big property gain and a conversion in the same year. Keep muni exposure in check if IRMAA is tight. If you remember nothing else, convert earlier, convert smoother, and size to your IRMAA cap, not just your tax bracket. That's how you build tax-free assets without buying a year of avoidable premiums. RMD management, taming the monster at 73. RMDs are when your IRA stops being optional and starts telling your MAGI what to do. At 73, the IRS forces withdrawals using your December 31 balance and a life expectancy divisor. Those withdrawals are taxable, flow into AGI, and 2 years later they can shove you over an IRMAA cliff for both Part B and Part D if you don't manage it. Your largest account will set your premiums. Why this matters? Strong markets in your late 60s can swell pre-tax balances, which swell RMDs, which swell MAGI. That's the chain that turns a healthy portfolio into a year of surcharges. Mastering RMDs means protecting your Social Security deposit and keeping premiums predictable. The thing most people miss is timing. You can't change the fact that RMDs start at 73, but you can change their size and their spillover. 2 levers before 73 make the biggest difference. First, Roth conversions in your 60s to shrink the traditional IRA base. Smaller base equals smaller forced income. Second, asset location that slows IRA growth. Hold higher growth assets in Roth where future withdrawals won't raise MAGI, and keep lower yield or tax-efficient positions in traditional IRAs to dampen the RMD. Now the powerhouse tool once you're 70 1/2, qualified charitable distributions. QCD sends money directly from your IRA to a qualified 501c3. It can satisfy part or all of your RMD, and the amount excluded doesn't raise AGI or IRMAA MAGI. If you're already giving, route it this way. The mistake I see all the time is writing checks from a checking account while taking the full taxable RMD. That's double pain. Redirect to QCDs and you cut the MAGI that drives IRMAA. Let me show you exactly how to use QCDs well. Line them up early in the year. Ask your custodian for their process and deadlines. Make sure funds go directly from the IRA to the charity, no personal detours. Keep acknowledgement letters from charities. Your 1099-R shows the gross. You or your tax preparer report the QCD on the return so it's excluded from income. Donor-advised funds and private foundations don't qualify. Don't send QCDs there. Coordination with your spouse matters. Joint filers have higher thresholds than singles, but survivor years are tighter. If one spouse passes, the survivor may file single with NER or IRMAA tiers while inheriting the larger IRA. You move while you're both here. Reduce the bigger traditional balance with conversions under your IRMAA cap, and use QCDs once eligible to satisfy RMDs without raising MAGI. That way the survivor faces smaller forced income against tighter lines. Asset location is your quiet helper. Put growth engines, equities with higher expected returns, into Roth to compound where withdrawals won't touch MAGI. In traditional IRAs, favor lower yield or tax-efficient holdings to slow the RMD base. In taxable accounts, use tax-efficient ETFs and index funds to avoid surprise distributions that stack on top of RMDs. The reason this works is compounding in your favor. A slower growing IRA equals lower future forced income. Common mistakes I see every RMD season. Waiting until December to take RMDs and discovering too late you crossed a cliff. Forgetting muni bond interest still gets added to MAGI for IRMAA while you're managing RMDs. Rebalancing in taxable with big realized gains in Q4. And letting an inherited IRA's RMD stack on top of your own with no mid-year forecast. Another sneaky one, reinvesting RMD cash into taxable mutual funds that throw capital gain distributions in November, compounding the same year MAGI hit. Here's a clean structure for an RMD year. In January, estimate your RMD using last year's December 31 balance and the IRS divisor. Decide how much you'll satisfy via QCDs if you're 70 1/2 or older and charitable. In Q2, tally actual dividends, interest, and pensions. Check your runway to the next IRMAA tier. If you're close, execute QCDs now and take the remaining RMD early to keep control. In Q3, review fund distribution calendars and trim tax-inefficient holdings in taxable. In Q4, no improvising, only moves you've modeled. Quick model to make it concrete. Your forecasted non-RMD income is $85,000. Your RMD is $30,000. You plan a $12,000 QCD to charities you already support. That satisfies part of the RMD without increasing MAGI. You withdraw the remaining $18,000 as taxable RMD. Your MAGI now tracks near $103,000 plus any tax-exempt interest. With the first 2026 cliff at $109,000 single and $218,000 joint, you stay clear. No Part B or Part D surcharges triggered 2 years later. If you're already over a tier this year, don't waste it. If you can't push into a higher tier with reasonable moves, consider fixing causes while you're here. Replace distribution-heavy mutual funds and taxable with tax-efficient ETFs. Use the year to finish a planned asset sale you can't avoid, then keep next year clean. Or, if charitable, increase QCDs to drop next year's MAGI once the new tax year becomes the look back. 2 guardrails keep you out of trouble. 1. A mid-year MAGI forecast that includes the full RMD and any expected capital gains distributions. 2. A hard cutoff. Complete QCDs before Thanksgiving so paperwork clears in the right year. Add a standing October reminder to request fund distribution estimates. If a fund projects a large payout, pivot before the record date. If you remember nothing else, estimate early, deploy QCDs first, and never let December decide your IRMAA. MAGI landmines, income you forgot counts. You've got the plan, now let's sweep for the sneaky stuff that pushes MAGI over a cliff when you least expect it. IRMAA punishes surprises, so we'll eliminate the usual culprits and set simple guardrails you can run every fall. Start with the biggest misunderstanding: tax-exempt bond interest. For IRMAA, municipal bond interest gets added to AGI to form MAGI. So yes, your muni fund can raise IRMAA even if it's tax-free for federal income tax. If you're managing to a tight tier, consider swapping some muni exposure to treasuries and taxable. Treasury interest is federally taxable, but there's no extra add-back beyond AGI, which keeps IRMAA math cleaner near a cliff. Next, landmine, mutual fund capital gain distributions. Active funds and balanced funds often throw big year-end payouts you don't control. You didn't sell, but the fund did, so you realize gains. If you reinvest, it still counts as income. The fix is twofold: move distribution-heavy funds out of taxable into IRAs where possible, and prefer tax-efficient ETFs or broad index funds in taxable. In October, ask fund companies for distribution estimates. If a fund projects a large percentage, swap before the record date or pause automatic reinvestment so cash doesn't force more selling. Dividends can bite too. Qualified dividends get better tax rates, but they still live in AGI and MAGI. Watch for special dividends and rising payouts in Q3 and Q4. If a high-yield position will throw a large check right when you're tight on headroom, trim before the record date or hold it in an IRA instead of taxable. Small trims can preserve your buffer and prevent a year of surcharges. Capital gains from rebalancing fly under the radar. Rebalancing is healthy, doing it in taxable in December without a MAGI check is not. Use cash flows, dividends, and IRA trades to rebalance where you can. If you must realize gains in taxable, pair with harvested losses earlier in the year or keep the total under your buffer. Don't let a tidy year-end cleanup turn into a 12-month penalty. Property sales are classic tier busters. Even with the home sale exclusion, large appreciation can leave taxable gain that flows straight into MAGI. Rentals layer on depreciation recapture and capital gains. If a sale is coming, design the year around it. Pause conversions, avoid discretionary gains, and consider January closings to shift the IRMAA impact by a full year. If you can use an installment sale, spreading gains can help keep MAGI under the cliff. Business and employment payouts stack late. Severance, unused vacation cash outs, non-qualified option exercises, and RSU vests often land in Q4. If you control timing, shift them into a year with room. If you can't, cap other elective income and prep your SSA 44 appeal if the spike is tied to ending work. Don't let a December paycheck decide next year's premiums. Roth mechanics have traps too. Backdoor Roths trigger the Pro-Rata rule. If you have pre-tax IRA dollars, a simple backdoor converts proportionally from all IRA money. That unexpected taxable portion raises MAGI. Before doing a backdoor, consider rolling pre-tax IRAs into an employer plan if available, and confirm basis tracking on Form 8606 so you're not taxed twice. Taxable interest seems harmless until it stacks. High-yield savings, CDs, and corporate bond funds throw steady interest that quietly fills your cap. If you're close to a cliff, keep excess cash in a competitive savings account, but watch the annual total. Interest is predictable, so plan around it. If muni interest is the issue, remember that treasuries can be cleaner for IRMAA math and taxable. Inherited IRAs create stealth income. If you're taking beneficiary RMDs on top of your own income, those required withdrawals can nudge MAGI over a tier. Forecast both sets of RMDs mid-year and use QCDs from your own IRA, if you're 70.5 or older and charitable, to lower MAGI while satisfying part of your required withdrawals. Don't wait until December to discover the stack. Part D has its own add-on that uses the same MAGI tiers. It's easy to forget when you're focused on Part B. A small overshoot can double hit you. That's why we target a 5–10% buffer under the next cliff and why we run the October check before record dates and payouts. 2 quick wins this week. 1. Audit last year's 1099s. List interest including tax-exempt, ordinary and qualified dividends and capital gain distributions by fund. Circle any positions with big December payouts. If they don't fit your plan, swap to more tax-efficient ETFs and taxable by early fall. 2. Add an October task. Request distribution estimates from your fund companies. If a fund projects a large distribution, act before the record date. Use a simple memory device. Sift sources, irregulars, funds, timing. Sources, list everything that hits AGI or MAGI including tax-exempt interest. Irregulars, one-offs like sales, severance, options, special dividends. Funds, flag distribution, heavy holdings. Timing, map record dates, closing windows, and Q4 traps. Run Sift every October. If you're within 5–10% of a cliff, you'll know exactly what to cut, swap, or defer. If you remember nothing else, IRMAA punishes surprises. Tame muni interest, control fund distributions, and never stack an irregular on top of a tight year. Do that, and these landmines become just another box on your checklist. The annual IRMAA checklist: repeatable, simple, effective. Routine beats reaction. When you run a simple cadence each year, IRMAA turns from a surprise letter into a line item you control. Here's the checklist I use with clients: clean, repeatable, and built to catch the $1 mistake before it costs 12 months of surcharges. Quarter 1, confirm last year's MAGI, set your safe cap and tune cash flow. Pull your prior year return or draft. Compute IRMAA MAGI the way Social Security does, AGI plus tax-exempt bond interest. Now set your safe 2026 cap 5–10% under the next cliff for your filing status. First cliff sits at $109,000 single, $218,000 joint. That buffer is your insurance against surprise dividends or mutual fund distributions. If you're already in a tier, adjust withholding on pensions or IRA withdrawals so you're not cash crunched, and set a small monthly reserve for potential Part D IRMAA to steady your budget. Still in Q1, map your MAGI drivers on one page. Pensions, annuities, IRA withdrawals, planned Roth conversions, interest including muni, ordinary and qualified dividends, rental net, business income, and expected realized gains. Circle anything you can control: conversions, gain harvesting, rebalancing, and timing of sales. Draft a provisional conversion amount that lands under your cap with a 5–10% cushion. Post the cap where you'll see it. Quarter 2, run a mid-year forecast and course correct early. Add up YTD dividends and interest and annualize conservatively. Plug in pension and annuity amounts to date, rental results, and any known gains. Add tax-exempt interest if you hold munis. Now layer your planned conversion. Stress test the total. If your projection sits within a few thousand of the next tier, trim the conversion, pause taxable gains, and consider swapping distribution-heavy mutual funds in taxable for tax-efficient ETFs to cut year-end surprises. If cash is thin, build a small reserve now so you don't create taxable income in Q4 under pressure. Quarter 3, lock sizing and set charitable strategy. This is where you finalize the conversion amount that keeps you safely below your cap. Don't rely on a December top-off. Markets move, funds announce distributions, and dividends drift. If you're 70.5 or older and charitable, plan qualified charitable distributions now. Call your custodian, confirm their QCD process and cutoff dates, and schedule transfers for early Q4 to satisfy RMDs without raising AGI or IRMAA MAGI. If you're not eligible for QCDs, remember donor-advised fund gifts don't lower MAGI. Good tax planning, but no IRMAA relief. Also in Q3, request preliminary capital gain distribution estimates from your fund companies. If an active fund is projecting a large payout, swap to a tax-efficient ETF before the record date or move that holding into an IRA if you want to keep it. Quarter 4, execute with discipline, no improvising. Before any move, run a fresh MAGI estimate. If you're within $3,000.5000 of your cap, freeze discretionary income. Stop conversions, stop realizing gains, and turn off automatic reinvestment in taxable if a big distribution is pending. Complete QCDs early if eligible, then satisfy any remaining RMDs and stop. If you experienced a qualifying life-changing event this year, retirement, work reduction, marriage, divorce, death of a spouse, loss of pension, loss of income producing property. Prepare Form SSA 44 with documentation so you can file as soon as SSA assesses you based on the old return. Pair the appeal with low current year MAGI. Fund spending from bank cash, taxable basis, or Roth withdrawals. End of year wrap. Lock the lesson. After December 31, reconcile your actual interest, dividends, realized gains, withdrawals, conversions, and tax-exempt interest. Note what pushed or protected you: an oversized distribution, a late sale, or a clean Q3 cut. Update your fund lineup if distributions were the culprit. Set a provisional cap for next year 5-10% under the next cliff, and pencil a Q2 conversion target with room for unknowns. Refresh your printed 2026 tier table and keep it visible. 2 automations make this checklist hum. 1. 4 repeating calendar events titled IRMAA MAGI check, Q1 plan, Q2 adjust, Q3 lock, Q4 execute. 2. A standing October reminder request fund distribution estimates. Many fund families publish them. Use those to act before record dates. Common mistakes this rhythm prevents: waiting until December to look, sizing conversions to tax brackets instead of IRMAA tiers, ignoring municipal bond interest, forgetting Part D's matching add-on, rebalancing in taxable in Q4 without a MAGI check, and missing the age 63 anchor year that sets your 65-year premiums. If you're 63, use a larger buffer, 10% under the next tier, and lock decisions by Q3. Quick wins you can do this week. Print the 2026 IRMAA tier table for your filing status and circle the next cliff. Write your cap 5-10% under it on a sticky note. Ask your custodian how to code QCDs correctly and what their year-end cutoff is. If you're within a few thousand of your cap right now, pause any elective income move until you rerun the math, and create that one-page income map. When it's visible, you make better calls. Repeat this checklist and IRMAA becomes predictable. Plan the income, check the tier, then move. That habit alone protects your Social Security deposit month after month. If you're already in IRMAA, fast reductions you can do now. If you're paying IRMAA right now, let's cut it fast. 2 levers work immediately: appeal if you qualify and push your current year MAGI below the next cliff. Do both and you can lower premiums in weeks, not years. Start with the appeal. If you retired, reduced hours, divorced, lost a spouse, lost pension income, had a qualifying loss of income producing property, or received an employer settlement, file Form SSA 44. That lets Social Security recalculate IRMAA using your current year estimated MAGI instead of the old 2-year back return. The sooner you file with proof, the sooner the surcharge can drop, sometimes back to the month the change began. Here's how to make it stick. Check the right life-changing event, write the exact date, and attach proof. Employer letter confirming your last day and new expected income, recent pay stubs, pension change notice, court decree, death certificate, or loss documentation. Estimate MAGI conservatively. IRMAA MAGI is AGI plus tax-exempt bond interest. If you're unsure, round slightly higher. You're aiming to land in a lower tier now and let the tax return lock it later. Now the second lever, cut this year's MAGI. If you hold municipal bonds, remember the tax-exempt interest still gets added for IRMAA. Near a cliff, swap some muni funds to treasuries and taxable so there's no extra add-back beyond AGI. Pause realizing taxable gains for the rest of the year. If you plan a Roth conversion, stop conversions, increase MAGI. Fund spending from bank cash, taxable basis, or Roth withdrawals to avoid creating new taxable income. If you're 70 a half or older and charitable, use qualified charitable distributions directly from your IRA. QCDs can satisfy part or all of your RMD without increasing AGI or IRMAA MAGI. Execute them early so they clear this year. If you haven't taken your RMD yet, complete the QCD portion first, then take only what's left as taxable. Switch income sources for a few months. Instead of pulling from IRAs, spend from cash reserves or sell taxable lots with minimal embedded gains. Inside IRAs, you can rebalance without tax impact. In taxable accounts, rebalance using dividends and new cash rather than realizing gains in Q4. Small shifts like that preserve headroom. What if you can't get MAGI down enough this year? You can still speed the reset. After year-end, file your return promptly. Once the IRS posts your lower MAGI, Social Security will recalculate IRMAA for the next year. Faster filing means faster relief. Here's a same-year playbook you can start today. Step 1. Run a fresh estimate, AGI plus tax-exempt interest. and compare it to the 2026 thresholds: $109,000 single, $218,000 joint at the first tier. Step 2. If you have a qualifying event, complete SSA 44 with documentation and submit immediately. Step 3. Stop elective income, pause conversions, delay gains, and avoid unnecessary taxable interest. Step 4. If eligible, route charitable giving via QCDs to lower MAGI while satisfying RMDs. Step 5. Fund expenses from cash, taxable basis, or Roth to bridge the year. Common mistakes to avoid now: appealing without proof, understating your MAGI estimate, doing a conversion after filing SSA 44, forgetting muni interest in MAGI, and making big taxable portfolio changes in December. Also, watch for mutual fund capital gain distributions. If fund companies publish estimates in October, act before the record date. Micro story: a couple came in already paying IRMAA after a late severance, and a December conversion pushed them over a cliff 2 years prior. We filed SSA 44 under work stoppage with an employer letter and pay stubs, then cut current year MAGI by pausing gains, turning off reinvestment, and funding expenses from cash. They used a $10,000 QCD to cover part of the RMD. Social Security dropped them 2 tiers the next month and adjusted back to the month work ended. If you're newly widowed, tighten your buffer. Survivor filing often shifts to single with narrower tiers, while IRA RMDs and portfolio income persist. File SSA 44 for the death of a spouse, estimate conservatively, and keep current year MAGI low with the same tactics. If the larger IRA is yours now, lean on QCDs and avoid stacking gains. One more quick win: review automatic withdrawals. If recurring IRA distributions exceed your actual spending, dial them back to only what you need or to the minimum required. Excess withdrawals inflate MAGI, and near a cliff, that extra $2,000 can be the difference between tiers. Finally, lock the lower tier. After year-end, confirm your 1099s, file early, and if you appealed, respond fast if SSA asks for actual numbers. Add 2 automations: an October reminder to request fund distribution estimates, and a Q4 rule: no elective income without a fresh MAGI check. Cut IRMAA once, then keep it down with that rhythm. Married couples versus singles, bracket math and survivor risk. Married couples and singles play by the same IRMAA rules but on different fields. The tiers are wider for joint filers and tighter for singles. That feels fine until one spouse passes and the survivor suddenly faces the same portfolio income and RMDs against narrower single filer thresholds. That filing status change alone can push a stable plan over a cliff. Why this matters: IRMAA is tiered with cliffs, not slopes. Crossing by $1 means paying the full surcharge for the year for both Part B and Part D. As a couple, your headroom might be comfortable. As a survivor, that cushion shrinks overnight. And if the larger traditional IRA rolls to the survivor, RMDs can rise at the same time the thresholds contract. That's a double squeeze you can plan around in advance. Here's the move that works: plan as 2 people but stress test one person's future. Every year, run 2 projections, joint and survivor. Joint uses your expected MAGI with the current joint IRMAA tiers. Survivor keeps the same investment income and expected RMDs, replaces 2 Social Security checks with the survivor benefit, and uses single filer IRMAA thresholds. If survivor creeps near a cliff, that's your signal to accelerate fixes while both of you are here. Coordination is your superpower. Start with a shared IRMAA cap 5-10% below the next joint tier, then decide who does what inside that cap. If one spouse holds the larger traditional IRA, weight conversions toward that account first. Shrinking the biggest future RMD does the most good for the survivor. Keep the other spouse's IRA flexible for years when dividends or gains run hot and you need smaller moves. Alternate income drivers so you don't stack them. Use an on-off rhythm. In an on year, realize capital gains up to your headroom while keeping conversions minimal. In an off year, prioritize conversions and avoid realizing gains in taxable. That prevents double stacking MAGI in the same return and preserves the buffer that protects both today's tier and tomorrow's survivor scenario. Social Security timing quietly shapes IRMAA for decades. Delaying one or both benefits can widen the runway for Roth conversions in your early retirement years, reduce current year MAGI, and build a larger survivor benefit. That larger survivor check helps cover premiums later if IRMAA rises. while the conversions you completed shrink future RMDs that would otherwise push the survivor over a cliff. Run both timelines, claim now versus delay, and pick the one that preserves the survivor buffer. Asset location amplifies everything. Put higher growth assets inside Roth so compounding happens where withdrawals won't touch MAGI. Keep lower yield or tax-efficient positions inside traditional IRAs to slow the RMD base. In taxable, prefer tax-efficient ETFs and broad index funds to reduce surprise distributions. If muni interest is chewing up your buffer near a cliff, swap some exposure to treasuries and taxable so there's no extra IRMAA add back beyond AGI. Now here's where most couples mess up. They size conversions to tax brackets and forget IRMAA tiers, which don't line up. They run a single joint plan and never test the survivor case. They stack a property sale and a large conversion in the same year to get it over with, crossing two cliffs with one decision. Or they start both Social Security checks early, raising current MAGI in the very window when conversions would have been cheapest and cleanest. Let me show you exactly how to coordinate the plan. Step 1. Set your shared IRMAA cap 5-10% under the next joint tier. Step 2. List MAGI drivers, pensions, annuities, IRA withdrawals, conversions, dividends, interest, including muni, rents, business payouts, expected gains. Step 3. Assign the conversion target to the larger traditional IRA first, and decide whether this is a gains year or a conversions year. Step 4. Run the Survivor tab, same portfolio income and RMD assumptions, single filer tiers, survivor benefit only. If the Survivor tab edges within a few $1,000s of a cliff, increase this year's conversions or reduce muni exposure to rebuild future headroom. Quick example. Joint filers keep MAGI near $190,000 with a 2026 cap set at $196,000 for comfort. One spouse holds the larger traditional IRA. They alternate years. Odd years focus on conversions under the cap. Even years allow planned gains while keeping conversions minimal. They avoid muni funds and taxable near the cliff and prefer treasuries for cleaner IRMAA math. On the Survivor tab, projected RMDs plus dividends once pushed the survivor $2,000 over the single threshold. They responded by leaning conversions to the large IRA for 2 consecutive years and delaying one Social Security benefit. The survivor projection now shows a 7% buffer under the next cliff. 2 fast wins for couples this week. 1. Build that 2-tab joint survivor spreadsheet and plug in your real numbers. 2. Decide your rhythm for the next 2 years, gains year versus conversions year, and write the shared cap on a sticky note where you both see it. If you remember nothing else, remember this: use joint years to fix survivor problems before they happen. Shrink the biggest traditional IRA under your IRMAA cap, alternate income drivers so you don't stack cliffs, and test the survivor plan every year. That's how you keep premiums predictable today and protect the survivor's cash flow tomorrow. Case studies, copy and paste IRMAA game plans. Let's turn strategy into templates you can copy. I'll keep numbers consistent with 2026 mechanics. The first cliff sits at $109,000 for single filers and $218,000 for joint. Your task is to set a safe cap 5-10% below your next tier, then back into actions. Scenario A, retiring at 62, Medicare at 65. Goal, clean age 63 return and lighter RMDs. Age 62, set your safe cap now, live from cash and taxable, and start a modest conversion ladder sized to your buffer. Clean up taxable, swap distribution heavy mutual funds to tax-efficient ETFs to avoid November surprise payouts. Age 63, protect the anchor year. Trim conversions, avoid large gains, and minimize muni interest so the add-back doesn't chew your buffer. Rebalance inside IRAs not taxable. Age 64, resume conversions up to your cap. At 70.5, root giving via QCDs to reduce future MAGI. Result, standard premiums at 65, smaller future RMDs, and a Roth cushion for flexibility. Scenario B, late severance at 63. Mission, appeal fast, keep MAGI low. Step 1, file SSA 44 under work stoppage or work reduction as soon as severance hits. Attach the employer letter, final pay stubs, and the stop work date. Step 2, pause elective income, no conversions or discretionary gains this year. Spend from cash and taxable basis, rebalance inside IRAs. Step 3, if you're charitable at 70.5 or older later, plan to use QCDs to keep MAGI down. Step 4, file your return early next year so the lower MAGI feeds the next determination faster. Result, surcharges drop quickly and don't linger for 2 full years. Scenario C, big capital gain at 64. Goal, contain the spike. Before you sell, run a MAGI forecast. If the gain pushes near a cliff, harvest losses first. In the sale year, pause conversions and avoid distribution-heavy funds and taxable. Swap before their record dates if estimates look big. If timing is flexible, consider closing in January to shift the IRMAA impact to a year you can plan around. If you give, remember only QCDs reduce MAGI, donor-advised fund contributions don't. The next year, rebuild headroom and restart conversions to your cap. Scenario D, high balance IRA at 72. 2-year plan before RMDs at 73. Year 1, convert meaningfully within your IRMAA cap. Token amounts don't justify risk. Replace distribution-heavy funds and taxable with ETFs. Year 2, in January, estimate your RMD. If you're 70.5 or older and charitable, schedule QCDs early to satisfy part of the RMD without raising MAGI. If you still have room under your cap, consider a small, carefully sized conversion, but only if it won't cross a cliff. Keep muni exposure out of taxable if your buffer is thin. Result, smaller forced income and fewer IRMAA years. Scenario E, single retiree with tight threshold. Play stricter buffers and smaller slices. Set your cap a full 10% below the next single filer tier. Ladder smaller annual conversion. Don't stack drivers, pick conversions or gains each year, not both. If a property sale or big fund distribution looms, pause conversions entirely. At 70.5, use QCDs aggressively to keep MAGI flat. Result, fewer cliff jumps and steadier premiums. Scenario F, couple planning for survivor risk. Joint cap set 5-10% under the next tier. Weight conversions toward the larger traditional IRA first to reduce future survivor RMDs. Alternate income drivers, odd years for conversions, even years for harvesting gains, always staying below your cap. Keep muni interest modest in taxable near a cliff. Prefer treasuries if you need fixed income. Run a survivor tab each year using single filer thresholds and one Social Security benefit. If survivor MAGI edges within a few $1,000s of a cliff, increase conversions this joint year to rebuild future headroom. Scenario G, already in IRMAA this year, decide on purpose. If you can't drop to a lower tier without extreme cuts, accept this as an on year. Complete a larger conversion that meaningfully reduces future RMDs, but make sure you don't push into the next tier. Clean your taxable lineup, replace distribution-heavy funds now so next year runs cleaner. If you qualify for a life-changing event, file SSA 44 immediately and pivot to low MAGI income sources so the appeal sticks. 2 quick copy-paste tools you can apply today. 1. The cap note. Print the 2026 tier table, circle your next cliff and write your cap 5-10% under it. Tape it where you make money decisions. 2. The October check. Calendar a recurring task to request capital gain distribution estimates from your fund companies. If a fund projects a large payout, swap before the record date or hold it in an IRA. Micro story. A single filer at 63 planned a large conversion. We split the move across ages 62 and 64, skipped muni funds and taxable during the anchor year, and swapped 2 active funds to ETFs by October. At 65, standard premiums. Their RMDs later came in lower, and their Roth gave spending flexibility without pushing MAGI. If you remember nothing else from these templates, set the cap first, choose 1 income driver per year, run the October distribution check, and protect age 63. Copy the scenario that fits and you'll cut IRMAA the smart way. The 1-page IRMAA survival plan, do this every year. Here's your entire IRMAA system on 1 page. Run it once a quarter and you'll keep premiums predictable, protect your Social Security deposit, and avoid the $1 mistake that costs 12 months of surcharges. Step 1. Set your safe MAGI cap. Pull the 2026 IRMAA thresholds for your filing status. The first cliff sits at $109,000 for single filers and $218,000 for joint. Now take the next tier above where you expect to land and set a personal ceiling 5-10% under that line. Use a full 10% buffer in your age 63 year in your first RMD year. Write the number down where you'll see it daily. Step 2. Map the 3 anchor ages. Age 63 is your Medicare entry price. Your age 63 MAGI sets your age 65 premiums because of the 2-year look back. Age 70.5 is your QCD start. Give directly from your IRA to satisfy part or all of RMDs without raising MAGI. Age 73 is when RMDs begin. Plan a year ahead so forced income doesn't blow your cap. Step 3. Choose your income order. In pre-Medicare years, fund living costs from cash and taxable accounts to create room for Roth conversions under your cap. During Medicare years, pull from Roth when other income would push you over a cliff. If you must tap IRAs, do it with your cap in hand, measuring the MAGI effect first. If delaying Social Security opens conversion room, model it. Lower current MAGI can unlock larger, safer conversions. Step 4. Automate the quarterly rhythm. Q1. Plan. Print your tier table, set your cap, and list every MAGI driver on one page. Pensions, annuities, IRA withdrawals, plan conversions, interest including muni, dividends, rental net, business income, and expected gains. Draft a provisional conversion amount that preserves your buffer. If you're already in a tier, adjust withholding so cash flow stays smooth. Q2. Adjust. Add up year-to-date dividends and interest, annualize conservatively, and plug in known income. Email fund companies for preliminary distribution outlooks. If your runway shrinks, trim conversions now, stop realizing gains, and swap distribution-heavy mutual funds in taxable to tax-efficient ETFs. Q3. Lock. Confirm any one-time events, property sales, option exercises, business payouts, and move them into a year with headroom or push to January. Finalize conversion sizing that lands under your cap. If you're 70.5 or older and charitable, schedule QCDs for early Q4. Turn off automatic reinvestment in taxable if estimates suggest large capital gain distributions. Q4. Execute. Run a fresh MAGI estimate before any move. If you're within a few thousand of your cap, freeze discretionary income, no conversion top-offs, no bonus gains. Complete QCDs and RMDs early, verify results, and stop. If you qualify for a life-changing event appeal, have SSA 44 and documentation ready to file the moment SSA assesses you using older income. Step 5. Place your funds strategically. Keep distribution-heavy mutual funds out of taxable accounts if IRMAA is tight. Favor broad, tax-efficient ETFs and index funds in taxable to reduce surprise distributions. If muni interest is chewing up your buffer, swap some exposure to treasuries in taxable. Treasury interest is federally taxable, but avoids the extra IRMAA add-back from tax-exempt interest. Inside IRAs, hold the income-heavy or less tax-friendly positions where current MAGI isn't affected. Step 6. Prepare to appeal in advance. If retirement, work reduction, marriage, divorce, death of a spouse, loss of pension income, loss of income producing property, or an employer settlement might occur, keep documentation tidy now. When it happens, you can submit SSA 44 quickly with a conservative MAGI estimate and align your income sources to match the appeal. Step 7. Run an annual reset. After year-end, reconcile actual MAGI, AGI plus tax-exempt interest. Identify what pushed or protected you, fund distributions, a late sale, an oversized conversion, or muni interest. Swap any problem holdings, adjust your buffer, and refresh your tier table for the new year. Repost your cap and reset calendar reminders. Here's the condensed checklist. Set cap 5-10% below the next cliff. Use 10% at age 63 and first RMD year. Mark age 63, 70.5, and 73 on your calendar with alerts. Income order, pre-Medicare use cash taxable, during Medicare lean on Roth to avoid cliffs. Quarterly cadence, Q1 plan, Q2 adjust, Q3 lock, Q4 execute, no improvising in December. Fund placement, tax efficient in taxable, income heavy in IRAs, curb muni interest near cliffs. Appeal prep, SSA 44 and proof ready for life events. Annual reset, reconcile MAGI, refresh thresholds, retune the plan. 2 sanity rules make it stick. 1. If you're within $3,000 of your cap in Q3, you're done for the year on elective income. 2. Before any late year move, ask, does this push me over a cliff? If the answer is maybe, don't do it. Protect the tier. That restraint is worth thousands in avoided surcharges. If you remember nothing else from this one-pager, plan the income, check the tier, then move. Do it every quarter and IRMAA turns into a number you steer on purpose. Micro-stories and pattern interrupts sprinkled throughout. A viewer wrote me in January, I was $287 over the line. Their December mutual fund kicked a bigger gain than expected. We ran the October check retroactively, too late for that year, but we swapped the fund to a tax-efficient ETF in March and set a 10% buffer. The next fall, their MAGI sat $5,800 under the cliff. No IRMAA letter. Here's where most people mess up. They size conversions to tax brackets, not IRMAA tiers. A couple converted to the top of 22%, feeling efficient. But the IRMAA cliff sat thousands lower. They paid the full surcharge for Part B and Part D the next year. We fixed it by setting an IRMAA cap, then converting up to that line. Tax smart isn't always IRMAA smart. Treat IRMAA as its own constraint. This next part separates beginners from pros, the October estimate. One client held a balanced fund that projected a 12% capital gain distribution. We swapped to an ETF before the record date, avoided a $7,400 unplanned gain, and preserved their buffer for a planned Q4 top-off. One email in October saved a year of surcharges. Before we continue, you need to understand the age 63 anchor. A retiree wanted a big conversion at 63 because I'm not on Medicare yet. 2 years later, that would have priced their age 65 premiums. We split conversions across 62 and 64, protected 63 with a larger buffer, and they entered Medicare at the standard premium. Don't do what one viewer did their first RMD year. They took the entire RMD in December, then realized the move pushed MAGI past the cliff. The fix the next year was simple: QCDs in October, remaining RMD in November, and no discretionary gains in Q4. Their MAGI landed cleanly under the line. Quick win you can take today: print the 2026 tier table, circle your next cliff, and write your cap 10% under it. Tape it by your computer. That single sticky note is quiet insurance against a very loud letter. Key takeaway and next step. Control MAGI and timing. An IRMAA turns from a surprise penalty into a number you steer on purpose, protecting your Social Security and Medicare budget. Grab the one-page IRMAA survival plan and checklist in the description, then watch my advanced Roth and RMD strategy video next to size conversions under your IRMAA cap. Subscribe for clear, step-by-step retiree money guides.